Welcome to another edition of the Trading Script, Markets in Motion. Oh boy, what a crazy set of days we have had, especially this last Wednesday when we saw the market going precipitously down and skyrocketing almost immediately, all on good data. The CPI was better than expected, and for some reason, at the beginning at least, the market didn't take it well. But then, of course, the market changed its mind and decided to rally. Now, we are not day traders on this channel. We are not trying to catch every up and down. What we are trying to figure out is which setups, more reliable mid to long term, we can find. And for that, we need to make sense of these markets. So without further ado, let's jump into some charts. Let's start, of course, with the SPY or the S&P 500 chart. Would you look at this? I think at this point it's becoming evident that the market wants to make a new high. And why not? Inflation data was positive enough to speculate that the Fed will start cutting rates. And what about unemployment data? Well, it was as bad as the market expected, so that's more than enough, it would seem. So what gives? Should we now FOMO into the market and just buy at any price? Before we just do that, we need to remain cautious and take a look at the VIX, because again, there's only so much information we can get from one single chart. So we need to look for clues elsewhere, starting, of course, with the VIX. What's going on here? Well, at least for now, the VIX remains in an uptrend, namely above these exponential moving averages. So we cannot really say that there isn't any risk whatsoever in the market. As we mentioned in the previous video, as long as the VIX doesn't break below these moving averages and stay there, meaning on a closing basis, we cannot really say that the market will give us a steady uptrend. However, there's even something more important to note here, which is the formation of a potential negative divergence between the VIX and the SPY. And we say potential because we need to wait and see what happens when the SPY makes a new high. Very possibly going into the Fed meeting, if this new uptrend is real, meaning that we can trust it at least for a couple of weeks or so. Once the SPY makes a new high, the VIX simply needs to make a new relative low, meaning a lower low relative to the previous low. In this case, the one made on the 30th of August. But why is this necessary? And what happens if it doesn't? Well, let's look at some previous instances. And again, this has to do with what we mentioned previously regarding synchronization in the market. For example, if we overlap the SPY on top of the VIX chart, we can see that the SPY made a new high on July 10th and a higher high on July 16th. We can see that not only was a new low not made on the VIX, but that a higher low was made on July 16th. This is what we call a negative divergence between the SPY and the VIX, because it quite simply means that investors are hedging significantly so into a rally. And of course, we can see what happened next. So what happens now, or rather what could happen? Well, we simply need to once again pay attention to the VIX. If the SPY is to make a new high, of which we are very close, the VIX needs to make a new relative low on a closing basis, and preferably as it breaks these moving averages. Then, of course, we can look for buying opportunities or long entries. But until then, we need to remain cautious and not FOMO into this rally. Last but not least, we need to mention that when the market rallies into an important event, this has a tendency of producing a pullback. So, for example, if the market rallies all the way into the Fed meeting, creating a higher high on the SPY and a higher low on the VIX, well, those wouldn't be good news for the days ahead. Of course, we hold no biases on this channel, so we might as well have the VIX breaking down tomorrow. And then the risk of a significant pullback, or one that breaks the uptrend, would decrease. Nevertheless, that hasn't happened yet. For now, we'll just keep tracking the markets until we find a good setup in either direction. Thanks for watching, and don't forget to comment and subscribe as we bring you more videos regarding market and technical analysis.